The experts on the technicals, we've got Larry Shover, Chief Investment Officer over at SFG Alternatives, and on the fundamentals, we've got Jason Brady, Managing Director and Portfolio Manager at Thornburg Investments. Jason, let's start it off with you. What do you make of these markets today?
Well, I mean, obviously there's a reaction both to Citigroup news, which is a little bit uncertain, I think, and adding some questions into the marketplace. But also, as you said, the economic data is pretty good, certainly better here in the U.S. than other places. In Europe, the best news we can come up with is that people are thinking about trying to ask for aid. I'm not sure that's a terrifically bullish theme, but in general, as you say, risk on, and it's really due to the prospects of a potential better economic environment going forward.
Larry Shover, how would you characterize this market?
Well, right now, we're in a severe Goldilocks market. Not too hot, not too cold. Longs need to have their hands held, positive reaffirmation, and it's really hard to be long right now. But one thing that you really need to look at, Adam, is that volatility across the board is cheap and getting cheaper every day. That signals to most options traders that the market's going to continue to climb higher. Let's look at XLF. I mean, XLF right now, 1 month volatility is in the 1 percentile. Skew is in the 8th percentile. I can't help but think that we're writing off quarter 3, quarter 4. We don't have a catalyst, so people just are going to remain long. But I would say long too, but continue to hedge your portfolio to the downside.
That actually sounds like that's why maybe you say Goldilocks, the best of all worlds. Markets are going up, so stay long stocks. Volatility's cheap, so you can go out and buy cheap puts. That's Goldilocks, right?
That's exactly what, well, not too hot, not too cold. I mean, the economic data is not hot, not cold. Earnings not hot, not cold. I mean, think of it this way. Our bottoms up, the number is what, 116, top down's 106. That's baking in a $10 of reductions right away with an anemic GDP number that we have right now. I mean, it's going to be a tall order for us to have a 2% GDP next year. So all that's being baked in, and we continue to go higher. So why not get into the equity market and hedge with downside protection right away?
Because if you look at the market, if you look at what the S&P has done this year, isn't there major pressure, Larry, for investors to get in and buy because they don't want to underperform their benchmarks at the end of the year?
Yeah, that's exactly right. And it's the same way in Europe. I mean, Europe's rallied 15% since June. People are scared to get in right now. But, I mean, when you look at option implied volatility, there hasn't been a better time in a very long time. Let's keep in mind, we've fallen down a 5-year flight of steps. We might not continue to rocket higher, but it seems like we're going to slowly drift higher. So get into the equity market, stay close to normal valuations, and hedge with downside protection. I can't preach it enough right now.
Jason Brady, the firm Thornburg Investment manages about $81 billion. If I understand it correctly, you oversee fairly close to directly about $15 billion. And what's curious to me is you're putting a lot of money overseas in equities. Why?
Well, I think that it's not only a question of what do the fundamentals say, but then what are valuations. So I think Larry is absolutely correct in the sense that there are things that are, I'm not sure it's Goldilocks. I think downside protection is valuable at the moment. I think that the best downside protection is really good valuation. So when we're looking at fundamentals, I'm not seeing a whole lot of terrific fundamentals globally. So where I get my downside protection, my defense, is to say, well, what's cheap? Where do I have a good margin of safety? And frankly, it's a big, wide world out there, and the U.S. market has gone up quite a lot. There are lots of parts of the world where we really haven't seen this bull market, and I think the margin of safety there is much better.
Hey, so many guys come on our air talking about dividend stocks. I know you're buying dividend stocks outside the U.S. What types of names, what types of values, what's the appeal?
Well, the appeal is, again, sort of going back to what Larry was talking about. There are lots of ways to be long, but to still be defensive or still be kind of balanced. Dividend-paying stocks provide great cash flow. What's more is companies that tend to pay dividends, frankly, tend to not only grow their earnings faster over time, but be very focused on cash flow. So those things are really important in this environment, especially with higher volatility. We like things like telecom stocks, again, a basic business, very cash flow generative from the dividend point of view. From a good valuation point of view, global energy stocks seem pretty reasonable to us, and also likely a okay hedge, not a great hedge, in a potential inflationary environment.
For you, Larry, where's the one place you don't want to be right now?
Right now, I don't want to be exposed without being hedged to the downside because there's so many moving parts right now, and the market seems to be asleep. So there's no one sector of the market that I don't want to be in without being hedged right now. Better said, I'd prefer to be in XLF and spiders and be hedged. There's not one sector that I'm really scared of because there's cheap hedging opportunities right now.
Well, thank you both for sharing great market insights with us today. That's Larry Shover. He's a Chief Investment Officer at SFG Alternatives, and Jason Brady, guest host for the day, Managing Director and Portfolio Manager at Thornburg Investments.
All right, so here's